Hey, what's up, everyone? Today, we're diving into something pretty serious. But trust me, it's super important to understand. We're talking about the economy, debt, and a legendary investor named Ray Dalio. Now, Ray Dalio isn't your average Joe. He's the founder of Bridgewater, the biggest hedge fund in the world. And recently, he's been sounding the alarm, saying the U.S. is on the verge of what he calls great disorder. Why the alarm? Well, Ray says that every 10 to 15 years we see these economic recessions. It's like a cycle. Markets go up, then they get bubbly, and boom, they come crashing down. He calls this the short-term debt cycle. Basically, it's like a financial roller coaster we've been on many times before. We saw it with the pandemic in 2020, the 2008 financial crisis, even the dot-com bubble burst. You're probably familiar with those, but here's where it gets interesting. Ray says that these short-term cycles are happening on top of a larger cycle, something that's much more rare, called the long-term debt cycle. This long-term cycle happens, get this, every 50 to 100 years. That's once in a lifetime for many of us. The reason why many people don't know about this is because it happens so rarely. Okay, so where are we on that cycle? Well, back in 2019, Ray actually said we were late in this long-term debt cycle, which is a big deal. To show us where we are, he published this visual of the cycle we are at right now. Now, I want you to really wrap your head around this, because understanding this is how you can spot opportunities and make smart decisions. So how does our economy even work? We measure it with something called GDP, which is essentially all of the spending that happens in our economy. It's how much money people are spending. Okay, but what fuels that spending? Well, it's your income, sure, but also the credit you can get. And that's where the long-term debt cycle comes in. You see, in the long-term cycle, debt is what creates these massive bubbles. We live in a credit-based economy. Earning $50,000? You can still spend $60,000, maybe $70,000, with credit cards, loans, and mortgages. This extra credit spending boosts the GDP, making the economy look good, at least in the short term. You go buy that new car, those designer clothes, that extra guacamole, that's all great for those companies, and their revenues and their profits increase. But here's the thing, you're spending money you don't have. You're spending your future income, plus interest. Our whole economy gets built on people spending their future earnings today. If you think about it, your raises, profits, and bonuses are dependent on people spending money today, even if they don't have it. It's like a big financial party, but we aren't paying the check. Companies love it. They don't care if you're paying with cash or credit. As long as you're swiping your card, they're happy, but eventually most people hit a breaking point. And when that breaking point happens on a large scale, that's when we see either that short-term debt cycle tip or, worse, the long-term debt cycle tip. That is a major issue. Every day we break down what's happening in the economy, the stock market, the housing market, crypto, all the stuff you need to know to be in the loop. We make it fun, easy to read, and we have hundreds of thousands of investors who love it. Ever wonder why the economy seems to go through these booms and busts? It's all tied to how we spend money and, crucially, how we use credit. Think of it like this. When everyone's feeling good and spending like crazy, using both their cash and grabbing new credit cards, the economy's in a growth phase. It's like a party, right? But eventually, that party hits a tipping point. People max out their credit, they've spent all their savings, and now they can't qualify for more debt. Bam! This is the breaking point. Suddenly, that money going to Gucci and Chipotle, it has to go towards paying off those debts. What happens then? Well, less money is flowing through the economy. People are making less, businesses are hurting, layoffs happen, and everyone's salary starts to dip. And guess what? As salaries fall, credit worthiness falls too. Banks are way less likely to hand out loans when everyone's struggling. It's a vicious cycle. This is where the central bank, like the U.S. Federal Reserve, steps in. They've historically worked to boost the economy by cutting interest rates. We've seen this time and time again. 2020, 2008, even back in the early 2000s. They also sometimes print more money. It's like a defibrillator for the economy. Now, I know what you're thinking. Printing money? Isn't that inflationary? Hold that thought. Before we get there, let me show you where we are today, according to the wisdom of legendary investor Ray Dalio. Dalio says that the current debt cycle we're in started way back in the 1930s or 40s, when interest rates were basically zero. Throughout the decades, interest rates rose to a peak of around 16% in the 80s, then came back down again. Then 2020 happened, and they dropped back to zero. Between 2022 and 2024, they shot back up to around 5%. And here we are now, currently sitting at around 4.5%. And this is where it gets really interesting. Dalio says there are 4 key things that happen at the end of every long-term debt cycle. He talks all about this in his book, Principles for Navigating Big Debt Crises. Highly recommended, by the way. These patterns have happened throughout history, in the U.S. in the 30s, in England in the 50s, Japan in the 90s, and more recently in countries like Spain and Italy. So what are these 4 things? Number 1, people start saving more and spending less to pay down debt. Number 2, we see debt defaults rise because people can't afford their payments. Number 3, Dalio calls it deleveraging. People sell off assets like stocks and real estate just to cover expenses. This causes asset prices to crash. Number 4, the central bank prints even more money to stimulate the economy and try to make up for all the lost buying power. Okay, so back to that money printing thing. You might think print more money, sounder instantly more inflation, but here's where Dalio's insight is key. He argues that the central banks print money to fight deflation, not to create inflation. See, in our economic system, it's not just about the cash we earn. Credit is a huge part of it, and when people lose their jobs, they lose their credit worthiness. Credit vanishes from the economy, and remember, businesses like Chipotle or Gucci don't know if you're spending cash or credit. It all works the same. So, when credit disappears, the Fed has to print money to supplement it, to keep the economy going. This is why the money printing is designed to fight the deflation caused by the loss of credit. And there's one more thing that happens during this phase, according to Dalio. Wealth redistribution by the government, because when people start to make less money, the government needs to distribute the wealth so the economy can stay alive. We're talking stimulus programs, trying to boost the economy, all that good stuff. But here's the thing, when people are struggling financially, they pay less in taxes, right? So the government has a problem. They're spending more and bringing in less money. It's like trying to fill a leaking bucket. Now, what do? Well, they've got a couple of options. One, they can ask the central bank to basically print more money. Now, this isn't like hitting print on your home printer. It's a more complex system, but the idea is the same. It's like adding water to the bucket, but if you add too much, you could get, well, hyperinflation. It's like the water overflowing and creating a huge mess. Your money becomes worthless. Not good. Option 2, tax the people more, especially the wealthy. This is where some historical analysis comes in. This is like taking water from one bucket and pouring it into another, and it's what we've seen governments do in the past. They need the money to fund those stimulus and programs, but this has to be done in balance, otherwise it can cause a whole other host of problems. Now, this is where it gets really interesting, according to Ray Dalio and his research. He's saying we need to be careful here. Print too much money, and you risk hyperinflation. Print too little, and you can trigger an economic crisis. It's a delicate balance. And this whole situation, all this economic stuff, creates opportunity. Yeah, I said it. Opportunity. Because when everyone else is panicking, financially smart investors are looking for deals. Think back to the 1930s, the Great Depression. Tough times, no doubt. But some people who had the knowledge and the courage to invest found incredible opportunities. We've seen this throughout history. But hey, let's be clear, I'm just a random guy on YouTube. I'm not your financial advisor. Investing is risky. You will lose money at some point. So always do your own research. Never blindly trust anyone, including me. This is just my perspective. So how do we take advantage of this opportunity? Well, you need to be prepared before things get crazy. That means save your money, build an emergency fund so you're protected if things get rough. Live below your means. Don't spend all your money so you have something to invest. Educate yourself about investing and learn the process. No matter what's happening in the economy, you should be doing these 3 things. And look, we know recessions happen. They're a part of the cycle. We've seen 16 of them in the last 100 years. When they happen, don't panic. Stay calm and look for those investment opportunities. That's how you build wealth during these times. All right, guys, you made it. Now, I want to hear from you. What do you think about this long-term debt cycle? Do you agree with it? What are your concerns? Or maybe you disagree. Tell me why. Drop your thoughts in the comments down below. I'm excited to read them. Now, let's talk a little about applying this info. Let's say you bring in $5,000 a month after taxes. That leaves you with about $333. A lot of people pay rent, utilities, groceries, all that, and have nothing left to save or invest. We need to do things differently. So, be informed, be prepared, and most importantly, stay smart with your money. Thanks for watching, and I'll catch you in the next video. Make sure to subscribe and hit that like button.